Hello, in this video I'd like us to look at the financial plan for a business. First of all, in the first part, the first video, we'll look at the setup of the business and the cash flow, showing the money coming into the business and the money going out. In the second video in the series, we'll look at the profit that's been made during the period of time we're looking at, and also the balance sheet as it would look at the end of the period of time. So we'll first of all concentrate on the top bit here, which is the forecast of the cash that's going to be in this business. Just get it to a nice size there so we can see it clearly. Now, the business is a pizza parlour, and we've got some various information down here. The data bank, which is our sort of estimates or guesses of what we think is going to happen to the business, what we need to buy in to start the business off, and a calculation of how big our sales are going to be, how much money we expect to take from sales each month. And we're just doing a forecast only for 3 months. This is a cash flow forecast just for the first 3 months of the business. Normally you do it for a year at least, a 12-month forecast. So the cash flow, very simple really. It's physically when money goes into and comes out of the business. So the cash in, we're looking here, this is the money coming into the business. We've got some capital. We're assuming we've got £2,000 of our own money to put into the business to start it up, and we expect to get sales of £4,000 odd every month. I'll show you how to calculate that in a bit, how it's been calculated. The cash going out, we're going to rent, it's a lock-up shop we'll run this from, so we're going to rent the shop for £600 a month. We're buying a bike to do some deliveries on. We've got miscellaneous heating, lighting, we've got those expenses every month. We need to buy equipment like ovens, and we need to buy fittings. And also we need to pay wages to, we've got a couple of staff helping out to run the shop. And of course we've got to buy the ingredients to make the pizzas, the pizza dough and the tomatoes, etc. Now these figures, so this is all the cash coming in. There's the total each month of cash coming in, and here is the total of cash going out. That's all physically when that money is spent. And what we are aiming to come up with then is a analysis at the bottom here of, really this bottom line is the one we're after, of how much money we've got in the bank at the end of each month. And we can see from on this plan shows us, oh dear, we're going to be overdrawn in the bank in January, £2,000 odd, overdrawn by £1,000 in February. It won't be until March that if the sales etc go as planned that we'll get out of that problem. So that's very, very useful information for a business. They need to know that in advance so that they can plan to maybe get an overdraft or a loan or extra capital in order that the business doesn't need to go into that overdraft situation, or it's got enough money to manage. And of course your forecast may or may not be right. It may be better than that, it could be worse than that, so you've got to allow for those things, but this is our plan. By the way, the closing balance there, we get that simply by saying, okay, the opening balance is 0, it's a new business, so there was nothing in at the very start. We put the 2,000 in like on the 1st of January if you like. So we've got the opening balance, add on to that the cash coming in, and deduct the cash going out, and that would give you your minus 2,164. So it's opening balance plus the cash in minus the cash out. Sometimes you'll see these as receipts and payments. Cash in is receipts, payments is cash out. So that's the general idea, and we can get those figures. Now the sales figure, where do we get this £4,000 from? Well, all I've done, we could just guess 4,000, but the way I've done it, perhaps just for fun in a way, is I've assumed we get 5 customers per hour. Now you could watch another pizza parlour and see how many customers they get in. On average, obviously lunchtime will be more people than that, evenings probably more, afternoon probably only 1 or 2 people an hour. So it's an average. 5 people an hour, coming in 8 hours a day, 7 days a week, and let's have 4 weeks in a month, so that we don't get into complications like 31 days and February 28. So 4 weeks in a month. Now, if you multiply those four numbers together, you'll get the number of people, customers, coming in a month. And then we're assuming that each one of them, on average, spends £4. The average sale is £4. Of course, some people will just buy a Coke for £1. Other people come in and buy a whole family meal for £20. But we're saying it's an average. And if we multiply those all together, that's where we get our 4,480. This is an Excel spreadsheet. If I double click there, you can see it's those cells multiplied together which give us our sales figure. Don't worry about the formula there. We can sort that out at a later date. Okay, so that's the cash flow from our data bank. Sorry, I just forgot there the food cost. The food cost here, 1,344. That's 30% of the sales figure. So whatever the sales are, we're taking 30% of that figure as the cost of ingredients, and we have to include that in one of the things. We've got to buy the ingredients every month. Okay, so that's the end of this first part. In the next part, we'll look at the profit and the balance sheet. Thank you very much.